Hey, welcome back to another video. And today we'll be going over risk to reward. Risk to reward is an aspect of risk management as well. So it is a very important part of our trading and a part of risk management. So we have to understand what risk to reward is and how are we going to use it in our trading. So I'm going to go ahead and dive right into it. So risk to reward is how much we plan on losing on a trade versus how much we plan to gain. In other words, our potential loss versus our potential gain, or our potential risk versus our potential reward. So a quick example of that would be, let us say we are risking $100 on a trade, meaning we are okay with losing $100. We would now want to profit. If we were supposed to win, we'd want to win at least $300 because we don't want to risk 100 and then we get back the same 100. That would almost be like we getting back the same thing that we risk for. So we don't want that. We want to get more than we risk. So if we risk $100, we'd want to get back $300. If we risk 200 is fine too, based on your preference, but 300 would be a good number. So if you're risking 100, 300 be okay to get back. Same, and let us use another number. Let us say you risk $1. We'd want to get back $3. So that means we'd be getting 3 times our risk. So if we risk $1, we want $3. 100, 300, 10, 30, and so on and so forth. So we want to get back more than the amount we risk. And that is called a positive risk to reward. Can you imagine if we were risking $100 and then we just want to get back $10 from the market? That wouldn't make any sense, right? No, that wouldn't make any sense. So we want to gain back more on our trades. So if we take a couple losses, let us say we have 2 losses, then just our 3 losses, just by we winning 1 trade, we would basically wipe out back all those losses, and that is risk to reward. It means just always going for more reward than you plan to lose. And I already used the numbers already. So if we were risking 100, we'd want to gain back 300 and so on and so forth. So that's basically risk to reward. So what I'm going to do is I'm going to give you an example of how we'd plug in the numbers to look at the risk to reward, and I'm also going to show you the long and short position tool and how we a visual representation on what risk to reward would look like when we are in the market. So remember, let's review what's a risk to reward again. Risk to reward is how much you plan on losing on a trade versus how much you plan to gain. In other words, our potential loss versus our potential gain, or our potential risk versus our potential reward. So that is risk to reward. So remember that. And it is very vital to our trading. So we want to make sure we understand it so we can implement it in our trading. So let me go ahead now, and I'm going to show you a visual representation on how we'd be looking at risk to reward. So let us say we are looking for a buy. I remember when we are buying, we buy when the market is going up. We buy when the market is going up. So remember that. We are buying when the market is going up, or the market is in an uptrend. So that is when we want to buy, right? So I'm going to go ahead and I'm going to give you an example of what risk to reward would look like if we were using the long and short position tool. And I'm just going to calculate some simple numbers so we can understand what is taking place. Okay? So let me go ahead and show you how we would calculate it by using a chart named Gold, XAU, USD, and you can use any pair. It would be a little calculated a little different, but I'm just going to use this one, for example, to calculate the risk to reward and how we calculate our stop loss, and take profit based on a certain entry that we have. Okay? So make sure you are following in, guys. I don't want to lose it. So let me go ahead and show you an example of that. So let us say the market is going up and we want to take a buy, because remember, in buys, we want to buy when the market is going up. And then which position tool would use? The long one, the long position tool. So I'm going to give an example and say, let us say our entry was at 2,000, right? And this is just for number purposes. Let us say our entry was at 2,000. Remember when you say we buy where we want the stop loss to be? We want the stop loss to be below. And we want the take profit to be above. So when we are buying, we want the stop loss below and the take profit above. Meaning if the market goes lower and lower, we wouldn't bother want to be in that trade. But if it goes higher and higher, that is what we would want. So we would take profit when the market goes higher and higher. And that is because we are looking for buys. We are looking to capitalize on buys. So see, we have the long position tool now. And let me give you an example. Let us say we entered at 2,000, and I'm just using 2,000 as a number for simple reference. Let us say we entered at 2,000. So 1 minute. We entered at 2,000. I'm going to show you what it would look like on the chart. So 1 moment. Let me go ahead and show you what it would look like on the chart. So let us say we entered at 2,000. Right? So see, we have our long and short position tool. And see, this one is along this time. So let us say we entered at 2,000, right at this line. This line is 2,000. So we entered at that line. And say we are calculating our stop loss to be 50 points, because the market is measured in points or pips. Points or pips. So let us say our stop loss was 50 points. So our entry would be 2,000. And then because to how gold is calculated, 50 points would be just 5 from the 2,000. That would be 50 points. So we just minus 5 from the 2,000, and then we'd have 1995. That would be where stop loss is, because remember, it would be 50 points. If we minus just 5, it would be 50 points based on how gold is calculated. And then our take profit, remember how much? So the stop loss would be our risk, and the take profit would be our reward. So remember I said if we're losing $100, how much you want to win? $300. So we'd go, so if we are risking 50 points, we need to win, or take profit would be 150 points. So then our take profit would be 150 points, which would be 3 times our risk. So if we are risking 50 points of our stop loss, and then we want 3 times that, how much that would be? That would be 50 times 3, and that would be 150. So if you realize now we have 2015, and remember I said the 15 now would be 150 points. And that's how it is calculated on gold. So it's nothing to confuse about. We use it easy numbers so you guys can get it and not confused. So remember, so our entry was at 2,000. Our stop loss is at 1995. And you see it right there. Remember, the stop loss is below. Let me go ahead and show you. Remember, the stop loss below. So the stop loss would be this red line. The entry is already at the black, and the take profit here would be green. So remember, for the buys, we want to enter below and take the price higher. And this would be a perfect example. And that would be a risk to reward, and that would what we call a 1 to 3. So you can have 1 to 1, 1 to 2, 1 to 3, 1 to 4, 1 to 5, any amount. But 1 to 3 is one of the most realistic numbers where the market push for on a daily basis. Yes, you can go for more, but we want to stay consistent in going for that. We don't want 1 to 100 because the market don't do that all the time. Yes, of course, you can get it based on your stop loss and how far the market moves and how long you'll be holding that trade. But on a day-to-day basis, a 1 to 3 is a pretty realistic number. You can go for a little more too, but that will come with, more time, more knowledge, and more experience. So that's basically that for the risk to reward for a buy. I'm going to go ahead now and I'm going to show you it for a sell. So remember, easy calculation, easy maths. So say we're entering at 2,000. Let me just repeat. We're entering at 2,000. Our stop loss would be at 1995. That would be 50 points. That's how it's calculated on gold. And our TP would be what? 50 times 3, which would be 50 times 3 is 150 points. And that would be our take profit. And see, so we have our entry here at 2,000, our stop loss here at 1995, and our take profit up here at 2015. And that would be a 1 to 3. And let me zoom in on it and you will see when I highlight it, you're going to see a 3 there. See the 3 there? You see risk to reward ratio 3. That means 3, 1 to 3. So we are risking 1 and we're getting back 3. We are risking 100 and we are getting back 300. We are risking 1 and we are getting back 3. Okay. So that's it for the buy one. Let me go ahead now and show you the ones for sells. Let me go ahead and show you the one for sells. So let me go ahead and show you the one for sells. And remember on the sell, which one of the positions we're using? The short. Remember, short for sells and long for buys. And I'm going to use the same 2,000 just to make the same reference so you can understand it the same way and we are not confused, okay? So remember now, risk to reward for sells. Let me go ahead and show you that for sells. Let me go ahead and show you risk to reward for sells. 1 minute. So the sells now. So look how we're going to calculate the risk to reward for sells. Okay, so see we have our sell line, the same 2,000 line. We're not changing it because we want to make it just easy reference. So see, we have our short position 2 and say we are entering at that same 2,000 for sells. Or stop loss would now be where? Remember, when you are selling, our stop loss is where? Above. So the stop loss would be above. So our stop loss is above. Our entry would be this line right there still, the 2,000 line. And I'm going to put the TP at green. Or TP would be at green. Green, we are using green for the money. Green shows us the money, or the blues. So that's money. And so the sell now, let us say we entered at same 2,000. And remember, we are risking 50 points. So now our stop loss would be higher than our entry. And that would be at 2005. That would be 50 points. And then our take profit now would be at 1985. And if you realize right here, you see a 3. So our risk to reward is 3 because you are risking 50 points. And our take profit is 150 points. And that would make us have a risk to reward of 1 to 3. And I'm going to go ahead now and show you something. Let us say we're going to go for 200 points. How much you think our risk to reward now would be? A 1 to 4. So you see? 1 to 4. So that means if we were risking 100 this time, we'll get 400 because we change the risk to reward. So let me go ahead and change it back to not confuse you. We're just going to use the 1 to 3 for now. And that would be risk to reward for the cells. So remember, and let me just go over that again. For cells, we have the entry, and then the stop loss is above for cells, and then we're expecting the price to go lower. And then for buys, the entry is there, and the stop loss is below, and we're expecting the price to go higher. And that would be risk to reward. Remember, 1 to 3, risk to reward. So we are going for 3 times our risk, and it could be 1, it could be 2, 3, but we are choosing the 3, and that would be risk to reward. So we always want to ensure that we have a positive risk to reward to know that we are gaining more than we potentially stand to lose. That is really important, because there might be some times when we might lose two trades, and then we lose 2. And then because we win that 1 trade and win a 1 to 3, now we are back in profit, because that 1 win clean out those 2 losses, and not because we had a positive risk to reward. So we lose 2 and we win 1 and get a 1 to 3. Now we are at positive 1. So if we had $300, we had a $100 account, and we lose $20, and then we win $30 now, we are at $10 in the positive. So that is super important to keep us in the game long term, that our losses or wins clean out our losses. And that's because we have a good risk to reward. So that's it for this video, guys. I hope you understand it, and I hope I explain well. If you have any questions, please feel free to reach out. That's it for this video, guys. Thank you.